You have lots of cash, but you dare not invest because the stock market is trading at or near an all-time high. Does this situation sound familiar?
You may have come into a lump sum of money, maybe a bonus or inheritance, or maybe you've only just decided to start investing. Or maybe you thought that stocks have been so expensive for so long that you've been sitting on the sidelines as your cash pot grows and grows.
Whatever the reason for your cash pile, you desperately want to invest it but feel like you can't because stocks are so damn expensive. We hear you. It's a conundrum, since staying in cash will see inflation chip away at it and gradually reduce its buying power. You should never hold much cash long term.
You might be thinking, it'll be okay. Stocks are bound to fall in price sooner or later, and you'll invest then. After all, everyone knows buy low, sell high. But is it okay to wait for better prices? Good stocks often rise and continue rising. You may never get a better chance to buy. This is a dilemma that we regularly struggle with. So in this video, we're asking the question, should you invest at an all-time high? Let's check it out.
Welcome to Unshackled.com, the investment and finance channel and website that sets you and your finances free.
That was Andy and I'm Ben, and if you like what we say, hit the like button and click subscribe.
And as always, don't forget to check out the Money Unshackled offers page, where we bring you thousands of pounds of awesome offers when you sign up to various investing platforms and services. We'll link to that down in the description. Buy low, sell high works sometimes. Let's go back to mid-2013 and you've got your eyes on this stock when the share price is in free fall. It previously hit an all-time high of around $25 just several months earlier, but plummeted in price immediately after to around $14.
That's a 44% fall in just 7 months. When a stock is in free fall like that, it takes a brave investor, or a stupid one, to start investing, or to hold on to an existing position. With the benefit of hindsight, we know that the share price recovered, and by the beginning of 2015, it was trading around $33.
This would have been an incredible return had you bought low and sold high, but if you had sold, you might be kicking yourself now because this stock is Apple. And Apple recently hit a record high of $134 a share. So it didn't matter too much when you bought it, you would have made incredible gains either way. The opportunity to buy at such a discounted price was a gift from the gods. But you cannot rely on any meaningful discounts like this appearing on wonderful stocks.
Don't regret not buying. Let's skip ahead to the beginning of 2017, when the share price is trading at $33, another all-time high. At this point, many people will be thinking that they can't possibly invest as it's just so expensive.
Surely all you have to do is wait, and sooner or later there will be a better price because this is what happened previously. Well, waiting would have cost you a small fortune because the share price would never again be as low as $33. In fact, by buying at the then all-time high of $33, you would have quadrupled your money by today. That's phenomenal in just 3 years.
Buy high, sell higher. What Apple's share price history demonstrates is that you are unlikely to buy at the best price. But if you think a stock is at a good price today, then buy it. Don't wait just on the off chance that the share price falls, giving you a perfect purchase price. It might fall, but it is also just as likely to go up, especially if it is indeed a good stock.
When prices are falling in a stock we own, this just prompts us to carry out additional checks. Maybe the market has seen something we haven't. But if the stock does fall and you still see it as a wonderful stock, then just see it as an opportunity to buy more at a low price.
This is Netflix's price chart over the last 10 years. Almost throughout, its share price is at or near all-time highs. Towards the end of 2013, the share price was at an all-time high of around $43, and it has never been cheaper since.
Likewise, at the beginning of 2017, it was around $131, and again, it's never been cheaper since, and most probably never will. There has been some price volatility in 2018 and 2019, but in 10 years' time, will this matter? We're guessing that it won't, because good stocks continue to rise.
Buy low, sell high often doesn't work. There's a lot of really awful stocks out there, and we don't know if BT is one of them. It could well be. We've regularly heard people say that it's too cheap to ignore, and based on share price alone, they might be right. But you can't value a business by referencing what the past share price was.
The share price has fallen 80% since late 2015, from 500 pence to around 100p. All the way you might be thinking, buy low, sell high. But for 5 years, this strategy would have catastrophically failed and would have almost wiped you out. Even now I'm thinking, this is BT, how low can it go? Surely it can't go down any further. Well, the truth is, it can always go lower, which is why when we invest, we like to have a little upward momentum behind the share price.
That's not to suggest that BT won't spring back to life. It probably will, but money has an opportunity cost. And we cannot sit around for years waiting for this to happen. In contrast, if the share price of Facebook was struggling, you would at least expect it to have the ability to grow profits through more innovation and the share price to eventually catch up.
What happens when a stock hits a new high? When a stock hits a new high, it's great news for you and bad news for those watching from the sidelines too afraid to get involved. But the prices of high-performing shares can be slow to move when they publish positive earnings news.
Research shows that this happens because investors are cautious about piling into stocks at this point, even if the stocks are awesome. Many investors suffer from a psychological bias known as anchoring.
Investopedia defines anchoring as the use of irrelevant information, such as the purchase price of a security, as a reference for evaluating or estimating an unknown value of a financial instrument.
One consequence of this is that investors may value a stock based on some irrelevant past share price. So in the case of BT, you might think that the business is worth more just because once upon a time the market price was higher. Likewise, investors may be reluctant to invest in Apple because it is trading at near all-time highs, and investors may have anchored to a previous market valuation.
Anchoring is also a reason why there might be a delayed reaction to good company news. What often happens is a stock will slowly drift higher over weeks and months after the good news announcement. The upward trend is called post-earnings announcement drift.
In this video, we've looked at two stocks which had momentum and continued to perform up to this very day, and probably will continue to do so. One of the most noteworthy characteristics of the stock market is that a stock price tends to trend in the direction that it is currently going. If it is going up, it will likely keep going up.
Should you invest when the market is at an all-time high? So far, we've only looked at a few stocks, and you might be sceptical about whether this works on an entire market. Let's lay to rest any lingering doubts by looking at the S&P 500 and seeing if the same logic applies.
Here we can see the S&P 500 since 1990. In this time, the index of the 500 largest US stocks has increased by 820%, from 359 to 3315. Within this 30-year time frame, the index has recorded a new all-time high every 13 days on average. But you may have to wait years in between, as the new highs often come clustered together. The orange line indicates the all-time high at that time.
The all-time high prior to 1990 was at the end of 1989 when the S&P was just over 359. As you can see, the trend throughout the 90s was up, meaning the index was regularly hitting new highs. Up until around 1997, if you didn't invest, you would never ever get a better buying opportunity. And this even includes the massive crashes from the dot-com boom and financial crisis.
We all know that stock markets go in cycles, boom bust, boom bust. But as we have seen, the crashes in most cases do not go as low as on the previous occasion. In 2020, the COVID pandemic caused the S&P to plummet, but it didn't even drop below the peaks prior to the dot-com crash and the financial crisis. Had you been waiting in eager anticipation of cheaper prices, you would have missed out.
This might be too early to say, but had you invested from 2013 through to the end of 2016, you would not have had a better buying opportunity since, as many new highs were clustered together. As the S&P has shown, as long as you invest for the long term, then you shouldn't fear investing at all.
Can you tell when a crash is coming? There is no evidence that anybody can consistently time the market. However, one attempt to achieve this is to monitor historical price-earnings ratios and avoid the market when it's high relative to the past.
History tells us that a good time to invest was a few years from 2003, and this also happens to be a period when the price-earnings ratio of the S&P was below 20, as we can see here in this 30 years price-earnings chart. When it went above 20, it wasn't long until we had the financial crisis and the share prices tanked.
If we extend this price-earnings chart to show 70 years, we can see that the problem is that PE ratios have been on the high end for the last 2 to 3 decades. It's just not realistic to sit out of the market for this long, especially as not many other asset classes other than equities will compensate you.
One potential place to store your wealth in such expensive times is in gold. As this chart shows, gold has done very well in the last 20 years at a time when PE ratios have been very high, potentially indicating that investors are worried about the economy and overpriced equities.
What should you do? Hopefully we have shown that you can't just sit on your hands waiting for a better buying opportunity, as there will likely never be one, especially with high quality individual stocks. But we have also seen that some stock market highs are horrendous times to invest that may take decades to recover from.
To play it safe, we believe the best approach is to invest regularly and not worry about whether it's the optimal time to buy. In the case of ETFs tracking world markets, we regularly drip feed our money in monthly.
If we have a lump sum to invest, we will aim to fully invest it over the course of a year by also investing it monthly. This may lead to us buying at higher prices, but it significantly reduces the chance of buying right at the top.
In the case of individual stocks, we might not necessarily want to buy on a monthly basis, but equally, we don't want to buy our entire position in one go. We tend to buy small chunks and top up over time if we still consider it a good price.
Question of the day: how do you handle all-time highs in the stock market? Let us know in the comments below.
Thanks for watching. On this channel we talk a lot about personal finance, investing and all things money. And if you want to see more great content, please click the subscribe button below.
This is MoneyUnshackled.com. See you next time.